Hi, everyone. I'm Gary Broad from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I am coming to you from Ho Chi Minh City or Saigon, Vietnam, and excited to bring in our host, Rob Farian. He's the CEO and founder of Flying V, our digital marketing partner. Rob, how has your week been? And thank you so much for doing this at a weird hour.
No problem, Gary. Anything for the five things, no matter where in the world you might be. I think you've been all over the globe now, five things in a lot of different countries. So glad to support. But yeah, my week's been good so far. It's only Monday, but it seems like it's Wednesday. But it's one of those years, I guess, is what is transpiring. And here it is. It's already February and off to the races. But I want to start. We actually have some exciting news to break to everybody. I think it had to have happened, I don't even know, within the last hour or so. I'm sitting here at 7:21 Pacific time. I'm in Southern California, but we broke 1,000 subscribers on YouTube, which I think is, due for an applause and a thank you to everyone that has been subscribing to the channel, watching our show. And Gary, kind of cool. I don't know, small win in a long journey of decisions, whether good or bad. We'll find out later.
Yeah, it is great. And thank you so much to our audience. And, when we wrap up, we'll talk about some of the people who were involved. I also want to introduce our guest joining us for the week, Jeff Nicholas. He is an expert in AI data center construction design. When we get to thing three and we talk about DeepSeek AI, NVIDIA, Microsoft, Google, all of these hyperscalers who are building out capacity data center usage. We're going to bring in Jeff for his expert opinion, and we'll be getting to him in just about 10 minutes or so. Jeff, thanks so much for joining us.
Great to be here, Gary. Thank you for the invitation.
All right. Terrific. So, Rob, you want to get us started?
Yeah, sounds good. And thanks so much for joining the show. Gary, do we want to move that maybe to the first position and we can actually jump into point three, or...
Yeah, why don't we do that so we make good use of Jeff's time? We'll jump right into point three, and Rob, I'm going to introduce Jeff and introduce the topic. Jeff, just first of all, just give people a quick sense of your background. What have you done in the AI data center space?
Sure. I'm an engineer. I work on the development of facilities for data centers and other high-tech buildings. So it's about how do you put the facility together, how do you organize it, how do you respond to the program needs of the users, and in this case, it's typically the hyperscalers. So it's put a facility together as most cost effectively, efficiently, and as fast as they can. So that's kind of the mission that pretty much every developer is on at this time. So that's kind of what I work on.
All right. Terrific. Well, Rob, if you don't mind, I'm going to introduce this topic and talk with Jeff about it for a few minutes. The topic we're talking about, which is number three in the written version of the five things, is tech spending growth on AI infrastructure. Just 2 weeks ago, DeepSeek, the Chinese upstart, came out saying that they had a competitive AI model on just $55 million of spending. That sent the market into a tailspin as everybody worried, oh no, have Apple and Microsoft and Google and Amazon and Meta has spent an absolute fortune on infrastructure that they would no longer need. NVIDIA's stock price was down 17% in a day as people realized, oh no, what if nobody needs NVIDIA's best chips? Also, there was a huge crash in the independent power producer space as everybody assumed that the world didn't need more energy. That was something we challenged. Now, within a week, actually within days, Deep Knowledge Investing came out and said, we don't believe the DeepSeek numbers. We don't think there are shortcuts. And we don't believe they actually did what they did on $55 million. And NVIDIA's kind of second best or third best chips. We got confirmation of that last week as most of the Magnificent Seven reported earnings. And when they did, they talked about increasing their investments in AI and cloud computing, leading that charge from Microsoft, Google, Meta, and Amazon, who are collectively projecting over $215 billion in capital expenditures for 2025. That's a 45% increase from the previous year's spending. So our question to you, if these companies, the best AI companies in the world, are increasing their spending to almost a quarter of a trillion dollars, a 45% increase, do you really believe they think DeepSeek can replicate what they're doing on $55 million of CapEx? The answer is clearly no. But Jeff, you've spent much more time in this space than I have. What are your thoughts?
I don't believe it's actually about trying to replicate it with less energy or less technology. They can't go fast enough. Is every signal I've seen and every image I'm getting from anybody is we can't build enough chips, we can't build enough servers, enough racks, enough data centers, enough power to drive all that to keep up with the demand of where AI is going and where it's going to end up in 5 and 10 years from now. So even if the evolutionary development coming out of DeepSeek has made a big leap forward and they can make the chips perform better, better chips will just perform better than that. And those chips will get applied in the same way, and they'll simply be able to roll out AI services with those chips faster, smarter, more efficient. All that's real. That doesn't mean you aren't going to make the chips better. In fact, today's chips that are being made are going to be maybe not obsolete, but not the newest in a year or in 2 years. So all that stuff is simply growing, and they're just doing it better. And it's look at as an evolution and not a revolution, as NVIDIA talks about. Essentially, you can make it like the Model A Ford. When they came out with the Model A Ford, it was maybe 10 times cheaper than all the other cars being made at that time. Not less cars, more cars were generated off of that, and more use of cars. It's the same kind of idea. So yeah, they're still planning to go forward. They're still building as fast as they can. And it's not about the engineering of putting the facility together. It's about the efficiency of the use of the chip in the software putting the AI programs together. So that's the primary difference. A speculation of where some of the difference is potentially taking shortcuts in how they build the model. And if they simplify how they do that, the model uses less energy and it can generate answers easier and faster, but it might not be as accurate of an answer as coming out of the models out of the other AI programs of all the hyperscalers. That's kind of the discussion about where it's going.
So, Jeff, I think that's a really good point. And one of the things that Deep Knowledge Investing put in our version of the 5 things a week or two ago is exactly what you said. If you're trying to make a funny meme, like we always do funny pictures of Janet Yellen, the former Secretary of the Treasury, DeepSeek's less accurate version is probably fine. If you're just making funny memes, it doesn't matter. But if you're using it to come up with real answers, to do real research, to do programming, anything requiring a level of accuracy, that does matter. And 90% cheaper, but 90% as accurate may not be a good option for people. I think you're making the point that most AI users will want and need the more accurate version because the cost of a mistake is much greater than the cost of using AI. What are your thoughts?
Yeah, absolutely. So far, at least at the beginning, the use of AI, it's kind of a toy. It's a new invention that you can make something fly that doesn't really fly. That's all fun. Now they're trying to make AI do things like select stocks or design homes or design aircraft. When you start getting to significant, complex activities that have tens of thousands of thinking decisions that go into it, billions of decisions and chip activity have to go on to make that come together. You're not going to take shortcuts around that. You're not going to use an easy to build system, even though it's maybe a little less accurate. You can't deal with inaccurate when you get to those levels of thinking.
That's a great point, Jeff. And as somebody who selects stocks for a living, I can tell you that the accuracy is really, get the stock right. Don't worry about what it costs you to get there.
That's how
Gary,
they're
Go ahead, Rob.
I actually have a question for Jeff. Jeff, with all that being said, what do you think from both a threat and also an opportunity perspective does this create? So obviously, when you talk about AI and you talk about the scale and the ability to replicate and do that rapidly and more efficiently, right? The layman sees the Skynets and the Terminators and taking over, and what threats are those? Then also with that, and Gary, I think this was your point from a few weeks ago. Hey, even if we are getting more efficient technology, generally what's going to happen with technology, or what does happen with technology, is actually more and more of it will be used, which obviously you need to look at from an energy perspective.
I didn't really get the question in there. I'm
So in
not going to
terms
predict
of,
Skynet.
yeah, so
Rob,
in terms of what you're, yeah, go ahead, Gary.
Rob, I understand the question you're asking. Let me reframe it for Jeff. Jeff, it's a two-part question. One, as the NVIDIA chips or other GPUs become faster, more efficient, more capable, one, do you think that they'll use that extra efficiency to reduce power usage, or run it at as high a power level as they can and perform better? And two, can you talk about the power needs in these AI data centers? Because again, 2 weeks ago, everybody was saying we don't need more energy production.
Okay.
I don't agree with that, but you're the one who's designed these data centers. I'd love your opinion.
Sure. Okay. Sorry for not getting that understanding at the first one. They absolutely are heading toward deliver on the demand for AI services as fast as you can. And we are a very long way short of how people imagine using AI. Therefore, they're going to put every ounce they can into developing the models, improving the abilities to perform. Once they get close to that, and maybe that levels off and isn't such a skyrocket, what they're trying to do, and levels off to a more reasonable demand for it, then they'll move into efficiencies and make it work better. Probably also, while they're doing that, the chips will be getting more efficient as they design them. There's better ways to cool them. And those kind of things are happening concurrently. So that's already happening. It's my understanding that the current chip is actually more energy efficient in use than the older chips. They just demand way more simply because they're delivering that many more calculations.
Yeah.
So it's
Yeah,
tenfold calculations, twofold energy, something like that idea. So yes, they're going to continue use every ounce they can into making AI world better. And then efficiency will be the secondary and short on the heels of that.
So I want to emphasize the point that Jeff's making, which is the chips may become more efficient and require more power as a result. And the deep knowledge investing portfolio, we have enormous investments in the energy space, in particular nuclear energy and uranium, and independent power producers that are using nuclear, because those are the best, most reliable, cheapest, carbon-free options to supply power to these data centers. And, Jeff's point is, even if these chips become 5 times more efficient, you still can end up in a situation where they need twice as much power. Now, Jeff, I know you were telling me that the kilowatt usage of a rack of servers in the last 5 years has gone from, I think, 3 kilowatts to now over 100, up to 130 right now.
Yeah.
Imagine a few years from now, as these GPUs become 10 times more powerful, even if they need just double the power to get 10x the calculation intensity, all of a sudden we'd be at over 200 kilowatts per rack, and we're going to need a lot more power generation. Am I understanding you correctly, or do you have a different view on it?
No, that's a good summary of it. It literally has gone from 3 to 7 to 14 to 25 to most recently, we were designing it at 50, but halfway through the schematic design, they're talking about 70 kilowatts per rack. That makes them heavier, taller, wider, and deeper. So the physical dimensions grow, the power demand grows, the cooling demand grows, and the weight grows. So you have to build a more significant floor. So retrofitting a building now becomes complicated in all those dimensions: physically larger, heavier, and more power and cooling. All of those are real problems, and that's what makes retrofit of a data center that was built 10 years ago is very difficult to retrofit to current design standards. So anyway, the point is, yes, they are having to grow more, and the better you can make those data centers flexible and growable, expandable, scalable, that's where they want you to go. All the hyperscalers are looking for flexibility, and what that really means is growth opportunity.
So to summarize all of this, when the market for power and these AI hyperscalers just blew up a couple of weeks ago, one of the reasons why Deep Knowledge Investing did not sell any of our investments in these companies is because we talked to people like Jeff. We talked to people who are designing the data centers and realized that the need for power in the United States and all over the world is going to continue to grow. We are invested to take advantage of that, and those positions have recovered very quickly. It is being able to talk with people like Jeff that is one of the reasons why when people were panicking out of losing positions, we hung in there and made money from them. Jeff, thank you so much for joining us. It's always great getting your expertise.
My pleasure. Is glad to be part of this, and thanks for inviting me.
All right.
Yeah.
So Jeff, just one quick thing. Before you go, please, we're using Riverside. Please leave your browser open until everything is done uploading. It may take a few minutes. So you can cut the video, but please leave that browser and your internet connection open so that we can download all of your content to the server.
Sure, like 10 minutes maybe?
Yeah, it'll go quick, Jeff. And then Jeff, one other thing too. Did you want to do any call outs? Like, where can people get in touch with you? LinkedIn or anything you want to call out just in terms of visibility? Yeah, because obviously we get some good engagement on the account and would love people to be able to get in touch with you.
Gary, do you have
worries.
my content? Is there some way you can post it on this?
Yeah. So for people who are interested in Jeff's point of view, want to be in touch with him, understand the expertise that he can provide, I will put a link to Jeff's LinkedIn in the description for this video, and you'll be able to click on that and reach out to Jeff on LinkedIn. I strongly recommend speaking with him. I find my conversations with him to be incredibly useful and very clear.
Well, thank you. And again, great to meet you, Rob, and glad to be
Yeah, likewise.
Right.
Thanks, Jeff. Sorry, I think I could have worded that better too, so don't even sweat it.
All right. Thank you.
All righty.
Oh, good. All right, Jeff. Thank you so much.
All right.
Cool. That was great. Okay, so sorry about that. Yeah, we were dealing with a little things early on. Weren't sure what the timing was gonna look like, but hey, on the fly we do it. And actually, that was an awesome conversation. Just in terms of what's happening in the AI space, and obviously, Gary, what we've been talking about over the last month or so, and we'll continue to talk about over the next few, and I'm sure years and decades to come from now. Anything else to add? Gary?
Rob, I'll tell you, Jeff's expertise is really amazing. And, in those moments when people were panicking and selling their power positions, and, we own Talent Energy, which was suggested to us by Enrique Abeda of HX Research. That's been more than a double for us. And it would have been really easy to sell that position down. We would have made double our money and said, hey, great, we made 100%. And we did not panic out of our positions. We kept our uranium positions, our power positions, our energy positions. And one of the reasons is because, I was talking to people like Jeff and saying, this doesn't make sense to me. And he was saying, yeah, the power needs are going to keep increasing. And so, it's just hugely useful. It's obviously in this business, having terrific contacts, having people that I can reach out to get answers to from quickly is just incredibly useful.
Awesome. Regrouping. So moving on, this week's version of the 5 things is the President Trump is doing more things issue. Gary, again, I want to call it out too. We were talking about, we just crossed the 100,000. Wow, I'm all over 1,000 subscriber mark. Cool thing for DKI. Anything you were saying prior to Jeff coming on?
Well, just again, we really appreciate the audience on this, and we'll get to all of that as we wrap up. Rob, why don't we get to the other 4 things of the 5 things we've got?
Very good. All right, moving on. Gary, we're going to talk about U.S. trade barriers. We're talking about BRICS. Number 2 for this week. We're going a little bit out of order here. We'll fix that up. Thing number 2, Gary, the free and fair trade dilemma.
All right. So, Rob, obviously the big news in finance over the last few weeks has been President Trump's tariff talk. And a couple of weeks ago, we talked about how he used the threat of tariffs to get cooperation on non-economic matters. In that particular situation, the country of Colombia was refusing repatriation of their citizens. President Trump threatened tariffs on Colombian products. And, the president of Colombia very quickly said, I'll send my own plane to pick up my people. That was an example of using tariff threats and trade threats to get cooperation on non-economic issues. Now, that's not always the case. Sometimes President Trump is using tariffs or the threat of tariffs to level the playing field. And, because the United States has an enormous trade goods deficit, last year it was $1.2 trillion, with a lot of the imbalance coming from the BRICS countries. That stands for Brazil, Russia, India, China, and South Africa. A lot of those countries have gigantic trade barriers for the U.S. So they like selling into our market, but when we want to sell into their market, they have trade barriers up. So President Trump said, you know what, we want reciprocity. If you want access to the gigantic U.S. market, you should be open to products from our countries. And at various times, he's proposed tariffs of up to 100% on all goods from BRICS countries. And at other times, he said, we will have reciprocal tariffs. If you have tariffs of 120% on U.S. goods, we will put tariffs of 120% on your goods. If you're at 50%, we'll be at 50%. And so the idea of that kind of reciprocity is it forces countries to act as good actors. You want access to our market, provide access to your market. Our companies should be treated fairly. The other thing is it does create a space to open up more domestic manufacturing, and that is important. A lot of the U.S.'s manufacturing base has just been destroyed over the last 40 years as we've outsourced a lot of our production. Not having that capacity is a potential national security issue, and it's created entire communities where people have difficulty getting good jobs, getting good wages. There's a lot of destitution, a lot of drug use. And I think, President Trump is trying to use a more level tariff playing field to help restart American manufacturing.
Gary, how are these tariffs seen, popular, unpopular, in finance circles?
Well, so Rob, that's a really interesting thing that's going on. So in general, Wall Street loves free trade and loves not having tariff barriers. And the reason for that is because, from our point of view, we get inexpensive labor, inexpensive goods, and companies that can import inexpensive labor and inexpensive goods report very high earnings, and we get a high multiple on those stocks. And so that works out well for Wall Street. Those tariffs are much more popular in places like the Midwest or, other places in the South where some of the manufacturing base has been destroyed. And, people really want those good jobs, domestic manufacturing. It certainly would reduce some of the destitution and drug use. And they're saying, you know what, stop outsourcing our jobs for higher earnings for our companies. And so, look, we understand both points of view. We would like to highlight the fact that, while getting cheap things is terrific, we definitely need, not having manufacturing capacity in the US is a national security issue. We can't produce chips. We can't build ships. We can't make our own pharmaceuticals. These are huge issues where so much of that is made in China and Taiwan, which, is being threatened by China. These are big issues. And, one of the things I really want to emphasize is these countries that are complaining about potential Trump tariffs, they're not such good actors themselves. So just as an example, out of 88 countries listed in the Trade Barrier Index, and you can look at tradebarrierindex.org, out of 88 countries, Russia was number 87, India was number 88, Brazil in the high, I think 79, China in the mid 70s. The countries that are complaining the most about potential Trump tariffs have the biggest barriers to us. And there's every reason for US citizens to say, wait a minute, our markets are open to you. We should be able to manufacture. You should buy from us as well. And I think that's a reasonable point of view. And it's not crazy for President Trump to pursue that as a goal to make things better for all Americans, not just the stock market.
All right. Lots in there to unpack. Gary, we're going to stay similar in the BRICS area. We're talking about, and we've talked about this in the past, the competition to the dollar. Gary, thing number 3, potential BRICS competitor to the dollar.
All right. So, Rob, again, the BRICS nations are Brazil, Russia, India, China, and South Africa. But that coalition has now grown to roughly 24 countries all over the world that make up more than half of the world's population and almost half of the world's GDP. These countries, for the last couple of years, have been talking about creating a new currency to compete with the US dollar and are saying we want to either get off the dollar standard or actually replace the dollar as the world's reserve currency. Now, I've been saying for the last couple of years, we should take this threat seriously. And a lot of economists have said, no, they can't do it. It won't work. They can't cooperate. Who's going to trust them? And those are all valid points. But I want to emphasize, Rob, that the reason the idea is gaining traction is because the US dollar is increasingly being used as a political and international relations weapon. The US has utilized dollar-related sanctions to compel compliance and punish economies abroad. We've written and spoken about this for years. We've talked before about how the anti-Russian sanctions were ineffective in removing Russia from Ukraine, but what they did do was make the dollar in the United States look like an unreliable partner and an unreliable currency to much of the globe. As a result, the BRICS countries are saying, you know what, we don't want to use the dollar because we're worried that if we do something that Washington, D.C. doesn't like, you'll cut off our access to the SWIFT system. That's the system we use to process payments. You'll not allow us access to our dollar reserves. You'll deny us access to our own assets. And so that's why they're trying to reduce exposure. And President Trump has responded by saying, if you do that, if you go off the dollar system, we are going to impose 100% tariffs.
Is that because, and I'm assuming, yes, Gary, Trump sees the exiting of the dollar system as a problem for the U.S.?
It's a huge threat to the U.S., Rob. So one of the things that a lot of people don't understand is the primary export of the United States right now is dollars. And one of the reasons why the deep knowledge investing portfolio and my personal investments are so weighted toward assets that will benefit from inflation is because Washington, D.C. is printing huge amounts of dollars and we ship those overseas. And the reason it's worked and our economy hasn't collapsed is because there's still demand for the dollar overseas. Now, one of the things we pointed out in a recent version of the 5 things is that over the last decade, the dollar has lost roughly 9% share, which is a huge number, as the world's reserve currency. So other countries are reducing their exposure to the dollar because we're printing like crazy, we're exporting like crazy. And President Trump is right. We need that because at the moment that it's our primary export is not goods, it's dollars. And, the thing that I would point out here is I've been having polite discussions and debates with economists and market strategists for the last 2 years. And I've been saying, hey, this is something we need to take seriously. More than half the globe is saying we want to get off the dollar standard. And these economists have said, look, BRICS, they don't have a path to creating a reserve currency that could succeed. They can't challenge the dollar. The dollar is still the best currency in the world. Okay, fine. But I'm just going to point out that if President Trump is talking openly about 100% tariffs, he agrees with us that this is a potential threat to the country. He's trying to head it off. And the other side of it is the more the U.S. treats the dollar as a weapon to compel compliance, the greater the incentive is for other countries to reduce their reliance on it. It is a complicated topic, but one that I've taken seriously for the last 2 years, and the current administration, the current White House, is clearly taking it seriously as well.
Gary, this next thing number 4, has you wondering if we can get Nancy Pelosi to manage our fund. And if so, Gary, you said you would be all in, and I would be as well. Thing number 4, Gary, the U.S. Sovereign Wealth Fund.
Yeah, so thank you for clarifying, Rob. Deep Knowledge Investing does not want Nancy Pelosi managing our funds, but there is talk about a U.S. sovereign wealth fund. I have very mixed feelings about this. On the positive side, there are examples of sovereign wealth funds that have done a great job for their citizens. In particular, Norway has done a great job with it. Singapore has, Dubai, their Abu Dhabi Investment Authority. What they've done is they've taken national assets, typically energy-related assets, and used them to create a sovereign wealth fund. Now, the thing that I like about it is I've been complaining for years that the U.S. spends too much and takes on too much debt. Anything that has us investing instead of spending, you know what? That's a step in the right direction. The problem with this is those funds will be managed in a political way. And I guarantee you, if you're listening to this, you will be unhappy with something that's happening. So, for instance, if you're listening to this show right now, realize that President Trump and his team are going to be investing in carbon-based energy. And you might not like that. And you might say, wait a minute, I don't like the way you're investing. Well, at some point, the left is going to take over Congress and the White House again, right? Nothing lasts forever. And when that happens, you better assume that that future administration will be using gigantic U.S. positions in companies to compel all kinds of uneconomic things like green energy or more DEI practices. And they'll say, hey, listen, we've got $1 trillion wealth fund, and, we own 20% of your company, and, we want your board of advisors and your executive suite to match our DEI goals. And so, there are a bunch of people listening to the show right now who are going to say, wait a minute, we don't want that. That's not in our interest. So the issue I have with a sovereign wealth fund, Rob, is whatever we're doing is going to be used for political ends and not economic ends. And I don't know that that goes well for the rest of the country. At a minimum, it's a guarantee that at any particular time, half the country is unhappy with it. And our companies are going to be pushed around by Washington every 4 to 8 years. They're going to be told, we own a bunch of your companies, so pursue these policies. And then 4 years later, nope, we want these policies, something different. And I don't think that ends well.
Gary, I think the one thing that pops into my head and the most important question out of everything there is, would the U.S. Sovereign Wealth Fund be able to buy TikTok and make sure that the Gen Zers don't lose their TikTok? Or maybe could Elon Musk invest in the fund and buy TikTok?
Well, so, listen, I can't speak for Elon Musk. He does seem a little busy these days. And I believe he said he doesn't want to buy TikTok. But the fact is, I think the Trump administration is going to make it clear to China that they need to divest TikTok. In fairness, the prior administration put pressure on China as well. I think this is an area where both Democrats and Republicans agree that, the Chinese government having control of what our young people are seeing and watching and the way they're collecting data on American citizens is not in our best interest. So I do think there is going to be some sort of forced divestment of the U.S. assets of TikTok. Elon Musk certainly, listen, he owns Twitter. And what we found out last week, now it's X. What we found out last week is that, he cut all of the spending and people said, he's going to run the company into the ground. They're going to go bankrupt. Not only did that not happen, EBITDA, earnings before interest, depreciation, taxes, amortization, has actually grown. And companies are starting to come back and advertise on the platform. And he's actually made it more profitable. Good for him. So clearly he's capable of running it. If the Trump administration does start a sovereign wealth fund, they definitely could invest in TikTok. Now, that sounds like a great solution, but I'm just going to point out to everybody, stop and think for a minute. Over the last 4 to 8 years, conservatives have complained bitterly that they've felt like social media platforms like Twitter, when it was owned by, Jack Dorsey and then run by Jack Dorsey and publicly owned, and Facebook, like all of these social media platforms, the perception was that they were biased toward the left and that they restricted the reach of conservative accounts. They banned people, typically conservatives, and conservatives felt like there was an imbalance, that they were treated differently. So for everybody saying, wait a minute, this is great, the U.S. could buy TikTok, we'll own it in a sovereign wealth fund. If you're on the left, remember, it will be President Trump's people who will be influencing policy there. You might not like that. Now, for, Team MAGA, who's saying, yes, this is great, President Trump and his team and the MAGA team are going to be able to have influence over social media discussion, and our views will be represented. Well, President Trump has a 4-year term, not a 40-year term. At some point, the left will take over and they will be controlling it. And so, just remember that if you're in favor of the U.S. government owning these assets, right, what that means is at some point, somebody whose political views you don't like are going to be controlling conversation on those assets. And so you might be happy now, but you'll be unhappy in 4 years or 8 years, and vice versa if you're on the other side of the argument. Maybe this is a good time to think about, do we really want the United States in the business of managing policy for private companies or public companies? Do we want the United States running its own hedge fund? Or maybe they should just cut spending and let the American people do their own investing. That's really our position on it, and that's what we think would be best.
Great stuff there, Gary. Great perspective. And I think we've officially gone from Twitter to X. I'm calling it 25
All right.
Is the year. But you can still call them tweets. How about that?
All right. So the platform is X, but you tweet on X.
There you go. That's where we settled. I'm drawing the line for 25. Gary, moving
the line
to
has been drawn.
The line has been drawn. Moving to thing number 5 to wrap it up. Fun episode, kind of all over the place, but it's been great. We're going, I guess, kind of a good segue after TikTok. Talking China, going back to deflation. Too much manufacturing, too much malinvestment. You're saying thing number 5, Gary, China's worsening deflation. Here we go.
Yeah, Rob, that's surely been the issue. We've been talking for a while about China's economic issues and manufacturing issues. Last year, Chinese industrial profits fell 3.3%. And, you think, okay, big deal, earnings down 3%. But the problem is, China, their economic miracle was growing 7-8% a year for decades. Now, granted, it was coming from gigantic levels of poverty, and they've destroyed their environment in many ways doing it. But, they had a 2.3% decline in industrial profits in 23, 3.3% last year. At some point, that really adds up. So it's the third consecutive year of profit declines. They're starting to experience deflation as a result of lack of demand. And just to give you a sense, and we're going to credit Josh Reeves, intern from the University of Tennessee, for his research on this. Rob, listen to these statistics. A 55% drop in metal smelting and rolling, 45% decline in minerals, 22.2% decrease in coal. Basically, they are reducing their energy usage. They're reducing their industrial production, their metals production. These are the kinds of things that you see in an economy that's really struggling.
Gary, knowing that DKI has a position in Las Vegas Sands, obviously interested in your take there. If you've had any recent thoughts or adjustments in terms of position or what you're thinking.
So, Rob, this is something we've been watching really closely. Certainly, Las Vegas Sands stock has not performed well over the last few months because people understandably have concerns about the Chinese economy. And Las Vegas Sands has the majority market share, the largest market share in Macau, which is the world's largest gaming market. Now, Sands' Singapore asset, the Marina Bay Sands, which owns slightly more than half the market share in Singapore, has been performing incredibly well above all-time highs, well above the pre-COVID 2019 numbers. The concern is that things won't go well in Macau. The thing that I would point out to you is we're not seeing evidence of that. So, as Josh correctly pointed out, China's had 3 consecutive years of declines in, industrial earnings and economic earnings, and these trends have been in place for years. But what we're seeing in Macau is continued growth. Now, some people will say, well, wait a minute, didn't one of the big investment banks just take down their growth numbers this year? And we're seeing GGR, that stands for gross gaming revenue, down. And my response, and this is something that I've discussed with DKI subscribers, is, yeah, the aggregate numbers are down and I don't care. And here's the reason I don't care. GGR, or gross gaming revenue, is heavily influenced by a small number of VIP, premium gamblers. And those VIPs come and they gamble millions and millions and millions of dollars at the tables and they haven't come back. Well, guess what? That part of the market is not particularly profitable. And it's not the area where Las Vegas Sands specializes. The lack of VIP gaming is a problem for high-end places like Wynn. Las Vegas Sands is heavily weighted toward the mass and premium mass markets. Now, in those markets, the operating margins, the EBITDA margins, can be as much as 10 times higher than they are in the VIP market. And in those areas, we're seeing increased visitation and increased spend per visit. And that's why, even though the overall Macau gaming revenue is down, Las Vegas Sands is continuing to grow. Now, once again, people might look and say, wait a minute, the Macau numbers were down last quarter. Yes, because they are completing renovations at 2 gigantic properties. That will be done in the next 2 months. And once that happens, Las Vegas Sands will not only have all of their assets fully operational and running, but 2 of their properties will have been renovated, adding more high margin suites and better rooms. And the room rates are going up rapidly. And the occupancy is in like the 98% level. So Sands stock is down on big macro concerns. But when we look at the actual performance of the Sands hotels and casinos and resorts that are open, it's improving rapidly, and within the next 2 months, they're going to have all of their capacity back online. I still love the stock, particularly at these levels.
Great stuff, Gary. And that concludes this week's version of the 5 things. Be sure to head to deepknowledgeinvesting.com. Sign up for a free subscription. You'll get added to our mailing list. Please consider a premium subscription, $100 a month. I'll let Gary do the talking when it comes to return on that. But Gary does a great job going deep into investment positions, understanding the environment, at minimum, giving you the information you need to be informed about a lot of these markets and what's happening. So please either subscribe. I'll get off my sales pitch soapbox here. Gary, turn it over to you for the closing thoughts.
So, Rob, you just made the key point. Doing the 5 things is fun. And I love being on here explaining these ideas to our audience. And that's terrific. But my real focus is making money for our subscribers. And I spend the vast majority of our time trying to figure out, what the economic conditions are, how to position ourselves for that, and finding the kinds of stocks where we can earn 2, 3, 4, 5 times our money. at this point, Deep Knowledge Investing has more stock positions that have appreciated by 100% or more than we have positions that have lost money. So I think we're pretty good at it. If that's interesting to you, feel free to check us out at deepknowledgeinvesting.com. Rob, I also, as we've crossed the 1,000 subscriber mark, which is a really nice mark, I want to thank you. Everyone, Rob was the one who came up with the idea of the 5 things. It was originally just written, and then he came up with the idea of doing these videos. When I say he's the executive producer, he's really the guy who came up with all of this. He hosts this show with me. Even when I'm in Asia, 15 hours away from him, we do this at difficult hours. And Rob and the team at Flying V have been incredible support. I also think, we should take a minute of appreciation for Andrew Brown, our former intern from the University of Tennessee. A lot of our growth came when Andrew completely remade our YouTube presence and started posting shorts. We got a lot of growth from that. His role on YouTube has been taken over and improved by Nazim the Dream Abbas, also from Flying V. That's terrific. Finley Rowland has just joined us on the social media side, and I think she's going to do a great job. And Josh Reeves, also from the University of Tennessee, intern, has done a terrific job taking over from former interns Alex and Andrew. What you're hearing here represents a ton of work and research on his part. Josh, we think you're doing a terrific job. And if you like the new thumbnails, that's also Josh. So, I'm the one who gets to talk about the ideas here, but I have so many people, so many smart, dedicated people from Flying V and our interns who support me in Deep Knowledge Investing and what we're doing. I want to express appreciation for all of them. Finally, to you, our audience, we know your time is valuable. Thank you for spending it with us. For those of you who have liked and subscribed and commented, we really appreciate you and value you. And that's what we have. I will be broadcasting from Da Nang, Vietnam, going surfing there from next week. So looking forward to coming back to you next week with a whole new set of ideas and issues.
Thanks, everyone.